Hi. So after the turmoil of the last week or so, I wanted to give you some perspective and an update and some thoughts. The first thought is that it's very easy to determine what is responsible for this recent downturn. It's a sudden loss in confidence that the central bankers will always be able to levitate shares higher. We've grown used to a flood of easy money, and equity prices have rallied in response to them. Not only have equity prices rallied, but huge investments have been made around the world in infrastructure, factories, mines. Here's an article that you can see to my left, which I think is a Reuters report. It discusses the price that it costs to send a container from Asia to Europe. In the last week, it was down 26%. In the last 3 weeks, it's down almost 60%. Now, the reason that there is such a staggering decrease in activity is because there was a huge malinvestment boom. The flood of easy money made factories and mines believe that the demand was there at the consumer level. It was artificial. It was never real. And now commodity prices are crashing. Factories around the world are suffering. Everybody is trying to devalue their currency so that they can have an export competitive advantage. This is not yet over. The signs of economic slowdown are clear as day. The equity market seems to be the very last one to see it. They used to say the stock market was a forecaster. It doesn't seem to be forecasting much. If it drops 3,000 points in the last 2 weeks, what was it forecasting 2 weeks ago? So I caution you that the problems still exist. The problems that have been created by Greenspan, Bernanke, Yellen, Draghi, Abe, central bankers around the world, all of whom are on the same path. More and more money, jumpstart the economy. That didn't work. More money. Paul Krugman, a Nobel Prize-winning economist writing for the New York Times, actually, I'm not really sure if he won for economics or what field his prize is in. His recent column claims that the problem is too little debt. Perhaps if there was more debt, the problem would be solved. You know, these clowns have been using the same argument for almost a decade now. When it doesn't work, they claim that the problem was just too little of their medicine. Their medicine has blown the stock market bubble, which will crash. Prices are too high. They have to reflect reality. They have to reflect what earnings, what yield, what dividend return one can reasonably expect. The stock market does not go up in a straight line, even though it has for almost the last decade, and everybody's become convinced that that is normalcy. Well, it's not. The signs of economic slowdown are everywhere. The stock market seems to be the last to know, but it seems to have gotten the message. Take care.